Hi, I'm Janine Firpo, and I'd like to welcome you to the seventh of our 12 Fireside Chats leading up to the publication of Activate Your Money, Invest to Grow Your Wealth, and Build a Better World. I'm really excited because today we're going to be talking with Lisa Frusztajer about private investing, which for me is one of my most enjoyable forms of investing. It's really fun, and we're going to explain a little bit about what it is and why I've had so much fun with it. And I know Lisa has had a lot of fun with it too. So Lisa, welcome.
Thank you. Thank you. Really great to be here.
It's really nice to have you. And I know that you are something called an investor in residence at the Capital Network. So what is that? What is the Capital Network and what does it mean to be an investor in residence?
Before I answer that question, Janine, I just want to say first, again, how happy I am to be here and how thrilled I am to have been able to be part of this incredible project that you've done. And empowering women to invest is important. And as you say, a lot of fun. So to answer your question, the Capital Network is a Boston-based not-for-profit whose philosophy is we need to find ways to make investing open to as many entrepreneurs as possible by educating them, giving entrepreneurs tools and support, and by educating investors.
That's fantastic. And thank you also for your comments about the book. I mean, you were instrumental in helping me write this chapter. And I so appreciate your contribution. It was fantastic. And I really appreciated that we got to know each other a little bit more through the process, which has been a really fun part of this journey all along. I mean, the amazing women that I've gotten to know and to realize how many women are out there doing really incredible things. And you are an angel investor as well. So how did you get started doing that? What made you decide that you wanted to start investing in private businesses?
I'd always been an investor in the public markets, but the reason that I wanted to get involved in private investing is because it's the most direct way to have an impact with your capital. That's one thing. But the other thing is, if you look on a macro level, more and more capital is moving into private investing. And I was really, really curious about it. There are fewer and fewer publicly traded stocks. So if, as an investor, you want to hold the market, you really need exposure to private investing.
It's a really good point. It's a really good point. And I think it's an area that most people don't even think about, right? When we hear about investing, we're always told that what you invest in is the stock market. Maybe we're told about bonds, but it's very rare that we're told to think about investing in private entities. And I think it becomes really important for women, and particularly women who have a little bit more access to capital, to do this kind of investing. And one of the reasons is because female entrepreneurs right now are not getting the capital that they need to be successful. And this is true across the board. But if you're thinking about private equity investing, and private equity is when you own a part of the company. This is when we hear about venture capital. This is what they're doing. They buy ownership in a company. In 2019, so these are pretty shocking statistics. In 2019, of all the venture capital dollars that were expended in this country, only 2.8% went to female entrepreneurs. And in 2020, that went down to 2.3%. And if you're talking about women of color or other types of minority entrepreneurs, they're getting a fraction of 1% of the capital in this country that's going into venture. So it's all going to white males primarily. And from my point of view, this is one of the reasons why it's important for women who can and women who have an interest in this kind of investing to step up and invest in other women. Are you seeing the same thing? And are you doing a lot of your investing in female CEOs?
Yes, definitely. And I always like to put numbers into a context. So Janine, those single digit numbers that you cited are incredibly powerful statistics. But if we bring it down to something relatable, let's say you have an 8-hour workday and you counted that in minutes. Let's just sort of say hypothetically, what is 2% of your workday? It would be 10 minutes. And the point of that illustration is that what happens in any given 10-minute slot in your workday, it doesn't matter. It's like throwaway time. It's not going to make or break a difference in your workday. And so that's the context. That's the scope of these numbers. It's a drop, it's less than a drop in the bucket. So yes, the funding imbalances are egregious. If they existed in any other universe, like in the Senate or in medicine, et cetera, we'd be really paying a lot of attention to them. But as you say, in a time of crisis in COVID, the funding numbers actually got worse. So when we got anxious about what was going on in the private markets, we retrenched to what was familiar. And I couldn't agree with you more, because there's so much power in the ability to deploy capital, because the amount of money flowing to private investing is increasing. We can't just stand by and watch it happen. And one of the big problems is that this world historically has been very closed, where the reins are held in a small number of hands. Demystifying it is really crucial, and that's one of the things that your book is helping to do.
Yeah. The way that you explained those small percentages was really powerful. So thank you for that example. I hadn't thought about that. And the thought of it's just throwaway time is very compelling and concerning, right? And this is why I think it's important for women to think about this kind of investing. I think one thing that's important to bring up here is the difference between an accredited and a non-accredited investor, because this really comes to play for the first time in the topics that we've talked about so far when it comes to private investing. So anyone can invest in public markets, but not anyone can always invest in private investments. So to be an accredited investor, and I believe I have this right, you need to have an income of about 200 to 250,000 as an individual, 300,000 as a couple, or you need to have at least $1 million of net worth, excluding your home. If you have one of those two things, then you're considered an accredited investor, which means that the US government and the SEC thinks that you are informed enough to take very risky investment decisions. And private investing is often considered a high risk investment. However, if you don't have that, then you're considered a non-accredited investor. It doesn't mean that you are excluded from this type of investing. Because of something called crowdfunding, even non-accredited investors can invest this way for as little as $100. And I actually did that through a platform called Republic, and I made a $100 investment in a private company. So you can invest this way, but there are more opportunities for people who are accredited investors. So I think I got my numbers right. Do you know the specific definition of accredited and non-accredited?
Yeah, the threshold, as you said, it's $200,000 for an individual, $300,000 for a couple, and as you said, $1 million or more in investable assets, including your primary residence. One of the things that was added is that financial professionals can also be considered to be accredited investors, regardless of their income and their investable assets. So
that's a recent change in the SEC rulings, right?
Yes, it is. But the accredited investor standard is just another example of a potential barrier. Now, I'm all for investor protections. You really do need to know what you're investing in. So having a standard makes a lot of sense, but it's another example of some of the historical barriers to people getting into private investing.
Yeah. And, one of the things that we talked about earlier is that this is fun. So why do you find this kind of investing fun? Where's the joy or the energy for you in this form of investing?
where to begin? It is just, it's been one of the great privileges of my life to be involved in private investing, because the number of options are almost infinite. There are companies being formed every day and people launching amazing projects to do amazing things. The amount of creativity and drive and initiative and just the points of views that are represented are infinite. So you can choose the kinds of projects that you want to back. So you're able, and I really look at access to capital and having say over capital as an economic justice issue, and one that women really need to participate in. It's all about controlling or having a say over your destiny. So that's one thing. The options are infinite, but the community that convenes around private investing is unbelievable, and it's exciting. The learning never stops. And I mean that whether you're interacting with entrepreneurs who are using their creativity to build businesses, or if it's other investors who are also interested in backing projects, or the entire ecosystem, just people learning about different ways to mobilize capital. And the other thing I would say is that of all the industries that I've been involved in, I have found that it is probably the most collaborative industry I've ever been involved in. So it's a really interesting area, because on the one hand, as you say, private investing involves taking a tremendous amount of risk. You don't have to do it on your own. There are countless opportunities for learning and collaboration, and it's just really, really fun.
I am so glad you brought that up, because it is risky, but part of the way that you can mitigate that risk is by learning with others, investing with others, not putting as much down yourself, but actually pooling funds together. And there are, as you suggested, a lot of ways to do that. And what's really great is there's a lot of ways to do that as women with other women. So there are what I would call female forward angel groups, and we actually mention a number of them and how to find them in the book. There are also some of these really interesting learn by doing models where you actually become part of a cohort with something like Pipeline Angels, or other learn by doing models where you co-invest with a lot of other women. And I know that you're very involved in a group like that. So could you tell us a little bit about Portfolia and what it is, and how that works?
Mm-hmm. So first of all, I will say that women are leading the way in terms of how to collaborate in educating ourselves on how to invest. And women are leading the way on collaborating on investing itself. And that's one of the many things that I believe makes women very strong investors, because when you approach something and you say, I want to learn, I don't know everything that needs to be known, particularly in a high risk investment area like private investing, that is a huge strength, not a weakness by any means. Janine, you mentioned Portfolia in particular. It is just an amazing model. So Portfolia was started by Trish Costello, who for many years led venture capital training at the Kauffman Foundation. And the principle behind Portfolia is to create an investor ecosystem that will bring in women who may or may not previously have seen themselves as investors, and provide opportunities for educating ourselves on how to invest, but also having a front row seat at how a portfolio of private investments is put together. So it's not a black box. You see the pitch calls, you get access to the evaluation, you can be on due diligence teams. So that's one thing. It's the front row seat on how this really works. The other thing about Portfolia, and we'll probably get into it, but when you've got a very risky asset class, what you want to do is spread your risk across multiple investments. If you're investing in private companies, it is unwise to invest in only one. But if you're investing in more than one, you need enough money to diversify your portfolio. With Portfolio, you go in with a relatively small dollar amount compared to institutional private investing. And the money that you put in is spread across 10 to 18, let's say, companies. So you get immediate diversification, which is crucial in the private investing space. I'll also say that this is really an amazing moment in the investing industry, where the power of women's capital has been recognized, but that bridge between mobilizing capital, recognizing it and mobilizing it, still has a long way to go to be built. And Portfolio is one of those organizations that is harnessing the power of women's capital.
Well, and it's actually the precursor to Portfolio was a pilot called the Rising Tide Fund that both you and I were involved in, and a woman named Alicia Robb was also instrumental in making that happen. And it's a very similar model that Portfolio has taken forward. And for me, it de-risked getting into this type of investing. The initial investment was $10,000, which I felt was something I could afford. And I ended up with 8 or 9 different investments. And I also learned a lot about investing this way. So $10,000 may seem like a lot to some women. It may seem like not very much to other women. But if it seems like a lot, there are other ways through syndicates that you can get involved at even lower dollar amounts. Again, oftentimes if you're accredited in the $1,000 to $5,000 range. So there are ways to do this, even if you don't have necessarily a lot of wealth. And it's a really fun thing, as you mentioned. I mean, I love meeting the entrepreneurs. I love hearing about their businesses. It's really exciting to learn about what people are doing. And these women who are starting these companies tend to be so passionate about what they believe in. And it's just a really exciting environment to be around and to be around other women who are using their capital this way. Mm-hmm. So let's just give the viewers a little bit of insight into some of the kinds of businesses that we've invested in. What are 1 or 2 of your favorite investments, the things that you're most excited about?
I actually invested in a very interesting organization called Founders First Capital Partners, which is a different model from mainstream venture capital. It's a revenue-based fund. And what that means is that companies who are part of the fund pay a percentage of their revenues back to investors. And the fund is structured as a revenue-based debt fund. But what's interesting about it is that it turns out that's a very entrepreneur-friendly model, because the companies have a predictable debt, because the companies have predictable payments that they need to make. But more importantly, what Founders First is doing is deploying capital to support companies that are run by underrepresented founders. And that means people of color, women, and veterans. And in order to be part of the Founders First Fund, you need to go through a really, really rigorous screening process. I mentioned bridges between the availability of women's capital and deploying women's capital. Founders First is one of those examples where there is available capital. The challenges in this industry are rarely a shortage of capital, but getting that capital to flow to underrepresented founders has always been a big challenge. It remains a big challenge. And Founders First is creating that bridge. The other thing about it that I love is that in order to make money in venture capital, traditionally what has to happen is the company that you invest in has to be bought by another company, or it has to go through something called an initial public offering, which is also known as going public. That puts an enormous amount of pressure on companies to aim for that initial public offering or that acquisition. And the beauty of a revenue-based debt fund is that the investors make money and get cash flow even without an exit. But more importantly is that it gives entrepreneurs an opportunity to build sustainable companies that are going to be strong employers. So that's one of my favorite models. Revenue-based financing is becoming a little bit more common, and I believe that's a really healthy thing.
So you talked about so many things there, and I was like madly taking notes on what you were saying, because you're right. The whole equity model is just one model, right? And here's the crazy thing that I've learned. Part of that model was actually built off of the whaling industry, and the numbers they use in venture capital came from the 1800 whaling industry, but that's a whole nother story. But that model really requires companies to grow very fast. It's very focused on tech industries. It's limited in scope, actually. And it's so limited that only 1% of the companies that start up in any given year are even appropriate for that kind of model. So that means 99% of companies are not appropriate for venture capital. So how do they get money? And the same challenge that we talked about earlier, which is that of the venture capital money that is available, a tiny percent goes to women. A lot of those 99% other companies are started by women, people of color, or other minorities, and they have a hard time getting capital as well. So you're talking about a revenue-based model, which is an alternative form of debt, where debt is just giving a loan to these companies. And private debt is as much an opportunity for us as women as private equity is. And like you, I'm finding myself more and more attracted to the private debt model, because I'm not having to invest in founders that have to achieve outrageous scale in order to succeed. I don't have to wait until they exit, if they do exit. And in a venture capital model, there's an expectation that the vast majority of companies invested in will not succeed. And I actually want the vast majority of companies that I'm investing to succeed. That's part of why I'm giving them money. That's part of why I'm supporting women. I want them to be successful. So I'm finding myself increasingly attracted to private debt, just like you. But in the private equity space, I have some investments that I really love too. And so an example is a company called Evernew, which what they do is they take overstock clothing, like when Levi Strauss or any clothing manufacturer makes clothing, they often overmake, and there's stock that's left over, and some of that stock ends up in landfill. And so what they have done is they've come up with a mechanism to take the fabric and reduce it down to a liquid form, from which they then create new thread to create new clothes. So they have a cradle to grave sort of approach to the clothing industry, which I think is absolutely fantastic. And you can, as you suggested earlier, as a private investor in either debt, equity, or revenue-based investing, or whichever approach you take, whatever financing model, you can in fact choose the things that you really value and the places where you really want to have deep impact. And this is where it really gets personal, right? And when we talk about values aligned investing being very personal to your values, this is where it really, really shows up, which is super exciting. And we talked a little earlier about risk. And one of the ways to mitigate that risk is by collaborating with other people. And there's lots of ways that women can do that. But another way to mitigate risk is through doing due diligence. So what is due diligence? And for you, what are some of the most important things you look at in a company that you're considering for an investment as you're trying to make that decision?
It's a great question, Janine, because we hear the term due diligence all the time, and It's another one of those terms that seems like a black box. So what does it really mean? Now, you have to start with the assumption that private companies, and particularly young private companies, don't necessarily have a standard set of disclosures or standard information that you might see in a more mature company. And in fact, some of the companies you look at, they don't even have revenue, never mind profits. So if you're evaluating a public company and you want to do due diligence, it's a completely different story because you have companies with track records. With private investing, you don't. And what I typically look at, and I've done a lot of due diligence, you want to see evidence that there is a need for the solution that the company is providing. It's all very well to come up with a great idea for something that is really interesting to the founder, and that's crucial. But evidence that the market will actually pay money for that solution is crucial. And that could be in the form of a pilot or early revenue. It certainly doesn't have to be something that makes the company profitable, but you want to see customers lined up, partnerships, that sort of thing. The other thing that is really important to look for is transparency. Now, what does that mean? In my mind, it means things like the founder has an idea of what she is expecting in terms of a market response or a customer response, looks for that evidence and responds to it. It doesn't mean everything necessarily has to go right all the time, but what you want to see is a founder and founding team who are open to getting feedback, because the one thing we know when we're investing in a very early stage is that most things will not go to plan. So if you can see that founder responding, and it's somebody who will do whatever it takes in order to come up with an appropriate response, that's a real strength. So that, and the reason I call that transparency is because it's transparency about the way somebody is thinking and about the way that the market response filters into the company and the company plan. A third thing that's crucial is the founder's ability to assemble and to inspire a good team that works together, where people are aware of their strengths and weaknesses, where the founder understands where her weaknesses may be and seeks to bring in people who will complement her, and a team that is collaborative, and also a team that is diverse, that represents diversity on multiple dimensions, whether that is gender diversity, racial ethnic diversity, diversity of experience, even age. So those are some of the things. And I have to say, you could spend a lot of time doing due diligence, but the thing to recognize with early stage private companies is that there are a lot of unknowns. So taking an appropriate amount of time to get to know the company is really important.
And not taking too much time, because I've seen that too, where people who are making relatively small investments take an inordinate amount of the founder's time to make a decision. So, and I agree with you. I think, you started out talking about product market fit. Is there really a reason for this product to be there? Is it meaningful? Do people care? And I've been surprised to see how many due diligence teams I've been a part of, that has not been one of their primary considerations. And yet 50% of companies that fail because they don't get the product market fit right. And it could be that you start out with an idea, you think you've got it right, you may even have some revenue, but then as you're going down the path, you realize, oh, we didn't get this quite correct, and you have to pivot. And so the ability to be flexible, to be resilient when things go wrong, way wrong, because they will. It's sort of like the same thing about the stock market. If you invest in the stock market, at some point along the way, you will lose money on paper. Full stop. It's going to happen. You're going to lose money. The market's going to go down. Be prepared for it. Same thing with this. If you're a founder, you're starting a new company, something is going to go wrong. Many things are going to go wrong. Expect it, be prepared for it, right? And as an investor, you have to be prepared for that too. And so looking for those entrepreneurs who have the ability to be resilient through the downturns and still keep going, I think is really, really important.
There's another aspect to that, Janine, and your comment brought up a really interesting point, which is that a young company that's growing can't do everything. A young company needs to know how effectively to use its resources. So chasing after every market opportunity is not something that is going to be sustainable over time. It's just as important for a company to decide what it's not going to do as it is to decide what it is going to do. And one of the amazing phenomena with women-led companies is that statistically, they tend to be much more capital efficient than male-run companies. So what does that mean? Capital efficiency says you use the money that you have in your hand and you generate a good return for that amount of money. A capital efficient company generates a lot of value for the money that it has. And in part because female-run companies and underrepresented entrepreneur companies are so underfunded, they tend to be more capital efficient. They just don't have the option to waste the money that they brought in. So here we have a scenario where underrepresented entrepreneurs are grossly underfunded, and yet they're generating a better return on investment. It's both a good thing to do and a fun thing to do, but it's also a really profitable thing to do. It's a good investment.
Well, the other thing too, I mean, when we were talking earlier about the fact that women come together in communities to learn, a value as an investor, particularly if you are someone who's a little older, you have career experience, you've been an entrepreneur yourself, you understand how these businesses unfold over time. As an investor, you also have the opportunity to come in and be a mentor and to actually help the business succeed. And when you get involved with other women, like in Portfolio or some of the other types of things we've talked about, you've got a range of women with a range of backgrounds who are investors. And so women with different types of skill sets can come in and help these entrepreneurs at different parts of their journey. And this is actually a really big and important part of venture capital that many people are probably not aware of, that a VC not only gives money to support a company, they also work very closely with that company throughout its life to ensure that the company is successful. And so women with skills and assets can really prove invaluable to these entrepreneurs who need all different kinds of help at different points along their journey. And that is actually another really fun aspect of this. Getting involved in these companies and sitting on a board or being an observer or just talking to the founder from time to time is a great experience. And I imagine that you've done some of that as well.
I have, and I have to say, whether you've been an investor or you've never invested, you have something to add. I have a friend who says this all the time. Everybody has something to bring to the table. And so I really strongly encourage people, don't be put off by the jargon. Don't be put off by the obstacles. Don't be put off by the mystique that the only founders are, young white men who are doing tech companies. You have something to offer, and all you need to do is jump in, follow your instincts, follow your curiosity, collaborate with other women. As you say, there are lots and lots of opportunities to do it, and you have something to add.
Well, that I know I could talk to you for a very long time about this, and we have, but I think that that is such a brilliant place to end. And the only thing I would want to add to that is, and you don't have to just support entrepreneurs in this country. There are entrepreneurs all over the world who are looking for support, and there are avenues to help them. And oftentimes it takes even less capital to help somebody in a developing country, for example. And I've invested there as well and have seen some really amazing successes. And I'm very proud of some of the things that my money has helped make happen, if even just a little bit. And I think that's another big piece of this is that, and I've talked about this before in other sessions, there's just a deep and profound feeling of satisfaction and really joy to know that your money is doing something powerful and profound in the world, even if your money is only a little piece of the total solution. It's still your money and you're still part of it. So it's been wonderful talking to you. I so appreciate it. I so appreciate what you're doing for women and for helping to bring more women into angel investing and other types of private investing. And I so appreciate the help that you gave me on this chapter and all your thoughts and insights. So thank you so much. I know our conversations will continue after this, but thanks for being on the Fireside Chats. I really appreciate it.
Thank you. It's been such a pleasure to talk with you.
Wonderful. And thank you everyone for watching. Next week, we will be talking about something called alternatives. And alternative investments are literally virtually everything else that you could invest in that isn't publicly available. And in fact, many financial advisors consider the private investing that we talked about today as part of the alternative landscape. But alternatives include things like cryptocurrency, gold, real estate, timber, water, solar power, you name it, farmland, agriculture. If it is not publicly available, then it fits in the alternative bucket. So we're going to have 2 guests next week to talk about some of those options. Thank you for watching today, and we look forward to seeing you next week.